Okay, thank you, Don. I think Don's introduction of me will actually possibly go longer than my talk this afternoon, because I do realise we're in the graveyard shift and I'm between you and the Cooper's drinks tab this afternoon. So I hope to keep it short and sweet. A big thank you to Live Corp, ALEC and the WA Live Exporters Corporation for my invitation to come along and speak to you here this afternoon. And I'm hoping to provide you insights into what's happening in the world of ag investment, and through the lens of current trends, touch on how we can better attract capital for business adaptability, industry sustainability, and community accountability. Oxventure has been operating for about 9 years now, just shy of 9 years. And I realise there's lots of familiar faces here, and it's actually great to get back and see you all. And so when I started the company 9 years ago, it was straight after the GFC, and my vision was about trying to bring capital into agriculture to be far more effective in creating growth and development and the adoption of best practice. After 7 years working in a bank, I saw that there was a pretty big gap in the market. But a lot of the conversations that I had early in the piece, so sort of going back 5, 6 years ago, were pretty tough. Essentially, most of the investors that were in the sector were investors that had been there a long time or had vested interest or very long-standing alignment with agriculture. So when I was engaging with the financial investors and a lot of the market spaces, pretty much the conversations would close with the returns are just too low. But now, ag is the new black. There is so much exciting progress in ag investment, I didn't even really know where to start with my talk for you this afternoon. But I've chosen 5 key trends that I would like to give you insight into, and hopefully they will give you some valuable information around how to attract capital into your business and what opportunities are out there. So let's get into it. So the first trend I want to talk about is that the landscape for ag investment is changing. We've always had large investors in the ag space, pretty much since the very early days in Australia. Large foreign investors that have always been engaged in Northern Australia, but now we're not just engaging with, but being engaged by financial sources from both the financial markets and non-financial market sector. Key changes that are most relevant to the Australian industry is the re-emergence of institutional capital. This has been led predominantly by the pension funds from overseas, sovereign wealth funds and pension funds from overseas. Possibly some of the names that you'd be most familiar with are like PSP, owners who are from Canada, and also New Zealand Super. Also, another key trend in the landscape that's changing is that we're seeing a lot of engagement and investment in ag tech. This is a particularly interesting opportunity for agriculture. So in 2016, ag tech raised over $3.2 billion globally. That's just ag tech. And in 2017, it remains a highly engaged focus area for investors like Silicon Valley. And why that's important to ag investment, and particularly for traditional ag sectors, is it now is bringing in investors and investor types that would never normally engage with agriculture. So it's starting to inform them and engage them in our sector and our industries, and it's exposing us to a new landscape of investors that are seeing opportunities that our traditional investors and or industries are not seeing. So essentially on that trend, ag now has capital options, which for somebody who's been doing it for about 9 years is pretty exciting. The second trend I want to lead you into is that the structure of capital is changing. So partly off the back of the new and varied investor landscape and types that are turning up at the ag investment table, but also because many traditional investment structures just really didn't suit agriculture. So we're seeing a significant shift in capital structure innovation. In fact, investors are starting to drive this themselves. They're readily seeking structures that can better align interests of all parties and deliver outcomes that meet the interests and expectations of shareholders, markets, industry, and even community. For Australia, I guess, one of the key structures that is quite exciting, and of course I want to be very respectful of the time, and I don't have time to go through all of these, but just to touch on a couple that are really quite interesting, I think, and particularly for your sector, is the co-investment space and or capital partnering. So co-investment is where investors are coming in and investing alongside existing producers to grow businesses and create larger platforms. So this means that, it's really quite exciting for the Australian ag sector because we're still a predominantly family-owned sector, and we've got a lot of really fantastic management expertise and motivation and skills in that sector. However, it's fundamentally capital starved. Really in Australia, most family farmers have only had access to debt capital. So it's been extremely difficult to drive development and innovation with debt capital because you actually have to start getting a return from day one, and development and innovation don't always deliver returns from day one. So that's been a really exciting development that can motivate, support and proliferate the family farming sector and deliver management risk outcomes to investors. The other one I'll touch on that I've put on the bottom of the list, which has traditionally not been there when I've talked about the way that structured capital platforms has changed, is alternative debt. And I haven't got much time to go into that, but really just to say that particularly this year, I've been engaged by more investors globally, and more airtime was spent at Global Ag Invest in New York in April on debt than there was on equity. And this is particularly interesting to the Australian landscape, and please no bankers in the audience shoot at me, but fundamentally what I think you're going to see is that we're going to have a rapid increase in availability of alternative debt structures. And I guess, what do I mean by alternative debt structures? And fundamentally they're hybridizations of debt and equity, mezzanine finance, wholesale or private financing. These kinds of debt structures are actually quite exciting for our industry. One, just because it gives us an option, but two, because it actually can innovate the way in which it is required to be paid back, which means it can give the amount of time that a business or an operation needs to develop or innovate or grow. It's highly flexible and customizable. So I guess, both of those things, whether it's co-invest or alternative debt or the changes in structure, what we're seeing across the landscape globally is this increasing appetite for risk. So in the beginning, when I used to talk about ag investment, and I'd travel around and talk to a lot of the financial investors and high net worths in the private investment sector, I used to spend a lot of my time talking about ag from a risk perspective, because the perception was ag is high risk. So we'd be talking about climate risk and production risk and market risk and all of these things. So one of the things that structure has been able to do, like the innovations in structure has been able to do, is drive or shelter particular investors that have sensitivity around those production and operational risks. So typically passive investment or leaseback structures, things like that, can provide risk shelter. But we're also seeing investors starting to engage in ag that have really quite high risk appetites, so our venture capitalists. And usually along with risk comes high return expectations. And I mean, the ag tech sector can deliver that to a degree. But we're also seeing a lot of the traditional institutional investors come to me and specifically ask for infrastructure, logistics, and associated investments that are exactly designed to drive agriculture, or are intimately linked with agriculture, which is a really interesting development. That's only starting, that retric's really only starting in the last 2 years, but we're having the really big infrastructure investors, and both ag tech and infrastructure, I've been invited to their major conferences to talk about ag for the very first time. So they're having a whole session on ag at their major annual conferences. So we're starting to really expand this platform of people that are engaging and wanting to invest in ag, and we're driving a lot of this, this risk appetite. So that actually obviously has indirect effects on our industry and our businesses and our opportunities. Clearly, in the live export sector, innovations in ag tech can drive outcomes for animal welfare, and specifically logistics and infrastructure investment can obviously make your businesses more efficient and potentially drive costs down. So it's really great to see investors starting to come into that space. So while we're on the topic of risk, I guess this is actually a trend that I wanted to talk about for two reasons. One is it's probably the most talked about trend across the global ag space because emerging markets is a very interesting space for a lot of investors to get into, and they're now starting to combine both emerging markets and agriculture. So emerging markets are fundamentally countries or regions that are undertaking significant social, structural, and economic change. And as you can see by this map, in the last 20 years or so, the emerging market sector or countries that are undertaking significant transition, and this is actually a map that's supported by Morgan Stanley's assessment of emerging market bonds, has gone from 8 to 81 in 20 years. So we've had a massive growth in emerging markets, and there's a lot of willing capital that wants to get into emerging markets. And so this is particularly interesting because regions such as Russia, China, and Southeast Asia present interlinked benefits to the Australian live export industry. Investment in food and agribusiness in these destinations can drive demand and business relationships with the Australian industry. Further, for those of you that have projects or interlinks into Southeast Asia, you've got a whole new, extra capital, a pool of capital that you can tap into, because there are a lot more investors that are very interested in emerging markets that are also very interested in ag. So if you can combine those two, you have their attention. And this is actually my last trend. So I told you to be quick and speedy, but this is possibly the most important and will become the most significant issue facing ag investment, if not investment, full stop, into the future. And that is the issue of ESG, or responsible investing. So basically, this is about the changes that we're seeing in the investment and transaction process, particularly with a focus on responsible investing and the need to meet ESG criteria. Historically, this has been an issue predominantly for the really large, transparent, highly visible funds. So your pension funds, your sovereign wealth funds, and a lot of your large target funds have always kind of had an element of reputational sensitivity around investing in certain sectors. However, ESG is becoming the number one issue, and what I'm seeing is drilling right down into even small and private investors that run a much smaller platform, family offices, high net worth individuals. Pretty much we're seeing the ESG issue or responsible investing and impact investing issue starting to be the number one conversation on any investment target or project. So what is ESG? Basically, ESG stands for environmental social governance. It can often get given lots of different names: corporate social responsibility, sustainable investments, impact investment, ethical investing. I'm going to just chuck them all in the one bucket for today. But fundamentally, this is around reputational sensitivity for investors, making sure that they're investing in things that aren't actually going to be seen as sensitive to their stakeholders, and their stakeholders may even extend to the community, depending on who the investor is. What's important about this trend is that it's rapidly growing as the most sensitive issue, and it's likely to grow even more significantly into the future. Morgan Stanley actually estimated in their report that about $30 trillion will transfer into the millennial generation. And so the millennial, what we're calling the millennial effect, is actually what's driving this massive focus on ESG. And so much so that a lot of my investors are now putting ESG or the ethical investing, responsible investing criteria above criteria of desire, like returns. So that's been a really interesting transition. And there's very few large investors that I deal with that now don't have a specific person in a role that's usually titled head of responsible investing or head of ethical investing. And their job is just to measure the ESG risks on any investment process or any target. So I'm not sure that this slide is really easy to see or very, very clear, but it does talk a little bit about the millennial effect as far as those percentages that you can see, particularly the first one, is that 86% of millennials will choose an ethical or responsible investment over another investment. So 86% of them will choose that before they choose returns. So that's a really compelling number as we head into the future, and this generation makes more and more of the investment decisions. The ESG discussion is now kind of the cornerstone issue for me to present on in any presentation to any audience. But it's possibly more relevant and more important to the live export industry than any other sector. And this is partly because ESG isn't, always mitigated by best practice. It's not necessarily a factual measure. Getting good regulation and having best practice doesn't always mitigate the view on ESG. And so therefore, it's a very important hurdle or challenge that I wanted to kind of touch on today, particularly with this audience. ESG is perceptionally based. The perception of live export to the uninformed is highly influenced by rhetoric and, unfortunately, highly influenced by Google. So most of the investment teams, if it's a larger investor, even my high net worth investors will put teams of people together. And that's, I've partly campaigned very heavily, particularly on ag investment in Australia, to try and encourage investors to do more independent due diligence, more commercial partnership, so that they were making good, sustainable investment decisions that lasted in the long term, and we didn't need to have the discussions about why capital doesn't have a great experience in ag. So they're doing that, which is great. But the majority of their teams, and my job quite often is to go in and work with these teams and help them understand the actual transaction that they're wanting to do. So just to give an example, I was the commercial partner for QIC on the purchase of NAPCO, and I went in and worked with their team. So when their team doesn't understand something, and a lot of these people are incredibly smart people. They're amazing, they've worked all around the world, far smarter than me and much more technologically advanced. However, there is a lot of things in ag that they don't know or understand. And the number one thing that they do to know or understand it is put it in Google. So it was interesting to me to kind of draw a parallel on this point, because as I was putting this presentation together and I wanted to customize my little slide thingy with more relevant pictures, I put live export in Google and pressed images. So I've lived and worked in this industry, like in the beef industry and in Northern Australia, pretty much all my life, and certainly all my career. And I was viscerally taken aback by the images that came up. And it was just a really simple search. And I know everybody in this room knows this issue intimately, and you're probably sick of getting punched by it. But what I actually thought about that was, the challenge we have is that we can't change Google's algorithms, and we can't change the fact that there are very well-resourced people that are campaigning heavily against the perception of this industry, because again, this is a perceptional issue. So if we can't change Google and we're going to have to deal with these issues in investment, does that mean that if you're in live export, you're going to be challenged to raise capital? My opinion is no. And that probably seems a little counterintuitive to what I've just said. But I think the challenge is that we need to actually think about how people perceive this industry and educate themselves on it and tackle that up front. So in order to kind of illustrate that just quickly, I wanted to tell a story of a client of mine that's actually in Latin America. So Oxventure spends most of its time in Australia, but we're expanding into emerging markets in Latin America, so we're spending a lot of time over there. And this is a really interesting case, and I thought it was quite relevant because there might be a few sports fans in the audience that would be aware that the Socceroos are about to take on Honduras. I think it's tonight, or it might even be now. I've lost track of all time, but they're basically trying to qualify for the World Cup, and if they win against Honduras, although I understand it's not as simple as that, but if they win, they qualify for the World Cup in Russia. And interestingly, Channel 10, the show The Panel, actually caused an international event when they were interviewing Tim Cahill on this particular upcoming sporting match by suggesting that Honduras was the murder, or is or was the murder capital of the world, and that playing Honduras was pretty much akin to playing ISIS. And so that kind of sets the scene or the platform for the kind of challenges that my client had in perception. So my client, Napoleon Arujo, he runs one of the largest family-owned whitetail shrimp operations in Honduras. They have about 547 hectares of ponds, which currently grow out about 5 million kilos of shrimp. They turn off 1.2 million kilos of shrimp to markets like Mexico, the USA, China, and Europe. And they've been trying to raise capital to expand their farm. And basically, you know, they were faced with these perceptional barriers. They were faced with, you know, trying to raise capital in light of the fact that there was certain perceptions about Honduras. And they knew what those perceptions were. They knew that the concerns were that Honduras is full of crime and cartels and gangs, and that, you know, it doesn't have a stable banking system, and if you put your money as an investor into Honduras, it can just disappear overnight because it's so corrupt. And they also were faced with the fact that, you know, there were alleged human rights violations around, there's a lot of large US corporate shrimp farms around the Gulf of Fonseca, which is where my client is, near Choluteca, that had a lot of allegations against them on human rights crimes against the local villagers. So they're on an ESG basis, but also on a sovereign and destination basis. They had some pretty major hurdles to overcome. And you're probably you know, wondering how on earth we challenge those. So when I first met with them and went through, they sent me all their information, and I had a read of that, and then I went and met with them actually in New York, because my Spanish is okay, but it's not good enough without an interpreter, so we met on common ground. And basically they had this, you know, beautiful documentation. They had sustainability studies and viability studies and forward projections and export contracts and all this information, and not one single piece of it said anything about investing in Honduras. So the issue was, you know, if you put yourself in the investor shoe and you go and you sit at that table and you're thinking, this is a project in Honduras. It's a really stellar whitetail shrimp project with massive margins and really sustainable 12-year, you know, they've been in business 12 years. It's a great project, but they're in Honduras. And all they talk about is how they run their business, and nobody's talking about Honduras. You actually aren't hearing anything. You're just thinking, yeah, this is still in Honduras, right? So what we learned from that is we actually changed all the documentation. And I asked the family about, if I was an investor and I brought my money to you, and how safe is it? Like, how safe is Honduras? Like, how, you know, can a blonde Aussie female wander around there and be safe? And, you know, like, these are the perceptions that we have. So they had some really great answers for that. You know, that the government's changed the actual foreign investment system. They've got some great regulation. They've actually, all the crime, there are some crime gangs in Honduras, but they're in the far north on the border of Guatemala, and they're actually not down in the Gulf of Fonseca. It's actually quite a modern and progressive area. So they had some great answers, and I actually believe the live export industry has exactly the same thing. They have great answers. But it's kind of like, you know, that thing like when you're in a relationship or you're dating and you don't mention something, and then by the time they find out, they're just going to think it's bad because you didn't say it. So you got to say it. You got to have the conversation. And I'm not necessarily saying that when you have an issue that could potentially cause people concern, that you run a flag up a pole and wave that in their face. But it's really important that you cover off those issues. So if you're engaging with investors or business partners or joint ventures or offtake investors, it doesn't really matter. One of the key messages, and it's kind of simple, and I feel like I'm probably telling you something you all know, but I see it time and time again, and I just liked the Honduras example because they do have some really big perceptual barriers that are kind of draw parallels with live export. But the kind of take-home message was, have the conversation and you know, put it on the table and say, well, look, do you have some concerns about Honduras being a safe destination? And then they can actually feel free to say what they're worried about, and then you can overcome that. So hopefully that story talks a little bit more about, you know, talking about the elephant in the room and engaging with investors on that level, and not being afraid, you know, to put something out there that you're worried might actually be a deal breaker, because sometimes it just builds trust. So I guess in summary, and again, I probably don't have time to go through some of these key sort of capital matching, what are investors looking for, but the point I guess I wanted to make is, you know, that if you're looking to attract capital into your business, your industry, or your supply chain, it can be very valuable, if not very important, to look into the kinds of desires that investors have, like, and then match your project with that. So match the key elements that you can offer with those kind of desires. And so in that big landscape of expanding investors and capital pools that I mentioned at the beginning, all those kinds of types of investors have different desires and different needs and different drivers. So, you know, for example, the second one on the list is capital preservation. And we see a lot of investors coming out of Europe or unstable parts of the world who really just want to invest in something where they won't lose their money. And so ag's a great solution for that. And they're willing to take quite low returns. We've seen even investors willing to take 10, 15, 20-year journeys with a return hurdle of 3%. So now we're starting to talk reality for ag. Okay, so it's a pretty exciting landscape. So I guess that's the key message that I wanted to leave you with, is that this has possibly never been a better time in all of history to attract effective capital into agriculture. You know, and the number one complaint that I'm starting to get from investors is they just don't have enough investor-ready projects. So I would just really like to throw it out as a last take-home message that there is willing capital out there. They're looking to put capital into agricultural industry, and that capital can drive, you know, a more sustainable, more productive, more successful future for all of you. So I guess more than happy to take some questions from the floor. Clearly very passionate about this subject, so hopefully it's been of some value to you. Thank you.